Hi, this is Jay and welcome to Headways 360. In our last video, we had discussed about what is mutual fund and tried to touch upon the types of mutual fund. Today, we will try to get into more details on the types of mutual funds so that we are able to understand the same and relate it to our requirement, which will help us before the investment. Just to recap, mutual funds, as we know, is an investment scheme run by asset management companies that brings together a group of people and invest their money in stocks, bonds, and other securities. There are broadly three types of mutual fund: equity mutual fund, debt fund, and hybrid fund, which further gets divided based on the features and product categories. An equity mutual fund invests money principally in stock. These are also called stock funds. Equity mutual fund is further divided into five categories. First classification is where it is split as large cap, mid cap, and small cap fund, followed by diversified equity oriented fund, ELSs, that is the equity linked savings scheme, sectoral or thematic fund, and finally the index fund. Debt funds, on the other hand, are mutual funds that invest in fixed income securities like bonds and treasury bills. Debt funds are also referred to as fixed income funds or bond funds. Debt funds are further divided into liquid funds, gilt funds, and fixed maturity plans. Finally, hybrid fund is a mixture of both equity and debt funds to achieve the perfect combination to yield better results. These are further classified as equity oriented hybrid fund, debt oriented hybrid fund, monthly income plan, and arbitrage fund. Large cap mutual funds are equity funds that invest mainly in top 100 well established companies of India. These companies are some of the biggest brands in our country, and most of us use their products daily or are part of their services. They are ideal for investors with lower risk appetite, so adopt a long term perspective, stay patient, and remain invested to reap good returns over a long term. Best examples of large cap stocks in India are Reliance Industries, TCS, Infosys, HUL, HDFC Bank, and so on. Mid cap mutual funds, on the other hand, are equity funds that invest in mid sized companies, which are among the fastest growing companies in India. These are advised for investors with higher risk tolerance than large cap investors. So, invest in these schemes if you are looking for higher capital appreciation by taking higher risk. Federal Bank, Aarti Industries, Escorts Limited, Voltas are some well known companies in mid cap space. Lastly, small cap funds invest in smallest companies of India. These companies are beyond top 250 companies and are mostly unheard in our daily lives. While they can deliver fantastic returns, small cap companies are incredibly volatile and risky, as you can see losses in the short or medium term. Dixon Technologies, Alkala Mines, Granule India are some well known growing companies in the small cap space. Second category of equity mutual fund is diversified mixed fund, which is a mixture of large cap, mid cap, or small cap fund. Diversified equity oriented mutual funds are multi cap funds which change their allocation between sectors and companies based on market conditions. ELSs or equity linked savings schemes are equity funds which invest a major portion of their corpus into equity or equity related instruments. ELSS funds are also called tax saving schemes since they offer tax exemption up to 1.5 lakhs from your annual taxable income under section 80C of the Income Tax Act. ELSS has a lock-in period as we need to keep invested for a period of 3 years. Mutual funds that aim at investing in a specific sector are called sectoral funds. These funds invest only in businesses that operate in a particular sector or industry. For example, a sectoral fund may invest in sectors like banking, pharma, construction, and so on. On the other hand, thematic funds are the ones that invest in stocks based on the particular theme. The theme chosen by such funds may revolve around areas such as rural consumption, commodity, defense, and so on. For instance, a thematic fund may focus on rural consumption and invest in funds of all sectors that favor this theme. Index fund is an easy way for investors to get into stock market, but as you grow and learn better way of investing, the less desirable they will be. When we define an index fund, it is a type of mutual fund or an exchange traded fund with a portfolio constructed to match or track the components of financial market index such as Sensex or Nifty. These funds follow their benchmark index regardless of the state of the markets. The other category of mutual funds are the debt funds that invest in fixed income securities like bonds and treasury bills. They are further classified in three types: liquid funds, gilt funds, and fixed maturity plan. The liquid funds are debt funds that lend to companies for a period of up to 91 days. These are the safest funds among all the mutual fund categories due to their extremely low lending duration. Gilt funds, on the other hand, are debt funds that invest primarily in government securities. These funds have no risk of non-payment of interest or principal amount, but gets affected by interest rate movements as the government borrowings typically happens to be for a longer duration. An FMP or fixed maturity plan is one of the debt products that are offered to many first-time investors looking for an alternative to fixed deposits because they are tax efficient. Fixed maturity plans are closed-ended debt funds with a maturity period that can range from 1 month to 5 years. The last category of mutual funds are hybrid funds, which invest in both equity and debt funds for better returns. These can be further classified into four types, normally based on allocation of equity and debt composition. In the first classification, we have equity-oriented hybrid funds. These are the funds in which the fund manager invests more than 65% of the fund's asset in equity and the rest in debt or money market instruments. The equity component of the fund comprises of equity shares of companies across industries. On the contrary, the debt-oriented balanced funds are a hybrid fund wherein the fund manager allocates more than 65% towards debt instruments. The debt component of the fund constitutes the investment in fixed income such as government securities, debentures, bonds, treasury bills, and so on. The third classification of hybrid fund is the monthly income plan, or commonly called MIPs, which are the hybrid funds that invest predominantly in debt instruments. A monthly income plan would generally have 15 to 20% exposure to equities. This would allow it to generate higher returns than regular debt funds. The MIPs provide regular income to the investor in the form of dividends. Investors can choose the frequency of dividend payout as monthly, quarterly, half-yearly, or annually. In the last classification of hybrid fund, we have arbitrage funds, wherein the fund manager tries to maximize return by buying the stock at a lower price in one market. He then sells it at a higher price in another market. However, an arbitrage opportunities are not always available quickly. In the absence of arbitrage opportunity, these funds might stick to debt funds or cash. By design, arbitrage funds are relatively safer, like most debt funds, but its long-term capital gains are taxable like that of any equity fund. Although this is a very vast subject and each type of mutual fund is a chapter in itself, which can be further discussed, hope this video has helped in the basic understanding of each type of mutual fund. Thanks for watching. Signing off as of now. Stay connected, stay blessed.